What's up, everyone, and welcome back to the Stocked Up Show. We have an awesome video today. We're going to talk about how to find the true value of a stock. You can see companies out in the market with growing revenue, growing profit. In this video, we're going to show you the price to pay and how to calculate it by yourself. So, Hunter, there's a lot of things when it goes into valuing companies. We're going to show the audience how we like to do it. Essentially, there are two types of stocks in the market. You have value stocks on one side. These might be companies like Intel, Apple, Microsoft, Costco, Procter & Gamble, stuff like that. Then you have the growth companies that are a little bit newer to the market. Their revenue growth and profit might be a little bit more inconsistent. So there's two different ways you have to take in order to value those two types of scenarios. We're going to start off with, I would say, the easier version of value stocks. So, Hunter, let's say we're looking at Intel. How do we find out the price we should be paying for Intel stock?
Right, so you're going to have to forecast the revenue. You can either forecast the revenue or growth or free cash flow growth. I like to do the revenue growth because I think it's easier, and then you can look at their free cash flow margins and apply that, and then you can discount that back. So,
cool.
Calculator. Go to Intel. I do 10 years. For growth companies, I do 5 years because it is a lot harder to predict their long-term growth. So I do 10 years, and then I look at their net income margins and their free cash flow margins. Intel's free cash flow margin this recent time is because they're investing in the new plant. So I will keep that in mind. So I like to do anywhere above a 10% return for my required rate of return because I could just buy the S&P 500 and get 10.5 over long periods of time. So I might as well get more if I'm getting more risk with an individual stock. So I gave them 1% revenue growth on the low end. So I have three scenarios: a bear case, a base case, and a bull case. A base case should be hit like 80% of the time. It's not one that you should not be putting crazy ridiculous numbers in there. Like I saw somebody do Tesla and they did like 80% revenue growth for 10 years. That's so stupid. It's so stupid. Mind you, when we said Tesla was overvalued, it dropped 47% in like a month and a half, and we were right. Anyways, that's besides the point. That's besides the point. So, bear case, I put 1% revenue growth, 19% profit margins. I gave them lower than they've been getting for the past few years. And then I gave them a 10 PE, which is low, but they're trading at around a 7 right now. A free cash flow margin of 18% because they're investing into all those plants. So, and then I gave them a price to free cash flow of 10 as well. And then for the base case, I gave them 13% for all of them. So 3% revenue growth, 21% margins and that's even low net income margins for the past few years. So you still want to be conservative even on your base case. You should be a little bit conservative because anything can happen. Like we could go into a recession. Anything could happen.
Yep.
And mess those margins up. Like there could be, in recessions, profit margins compress. Like that's just what happens. So you want to be a little bit conservative on that end. And then gave him a 12 PE. Gave him 20% free cash flow margins. And then a 12 price to free cash flow. The market average for like PE and price to free cash flow over long periods of time, I'm pretty sure is around 15 to 16. So those are still low. And then I gave them 5% revenue growth. This is the bull case. 23% profit margins, 15 PE, 22 free cash flow margin, and 14 price to free cash flow. And I should probably switch that to 14 just to be consistent. But I had the PEs higher than because of the difference, and it should have been the other way. So anyways, hit calculate, and that'll give you the bear base and bull case prices that you would need to buy under. This is not price targets. It's you need to buy under to get the 13% return a year for 10 years, assuming these assumptions are correct. If you wanted a price target, you would put in 0, and that's the price that you could expect it to be in 10 years.
Right.
One thing to keep in mind is that Intel buys back a ton of shares. So really, this could be even more conservative. Like, this might be even more conservative than it should be, because they buy back a ton of shares, and that will help drive up the price too, because their EPS will grow from that automatically, even if their earnings don't.
Yeah. So, long story short, when you have a value type stock, there are a couple things you have to guess. One of those things are revenue growth, and you have to keep in mind that it's like compound revenue growth. So it's like when you're guessing, like Hunter did for 1% revenue growth with Intel. That's not just saying, oh, in 10 years from now, their revenue is going to grow by 1%. It's saying that Intel's revenue is going to grow by 1% every single year for the next 10 years. 1% might seem like nothing, but when you compound that year after year after year, it's more than you think. So, step one, guess revenue growth. Or not guess, but look at historical data like we have access to on the dashboard and say, what's a reasonable worst case scenario this company's revenue will grow by. Put that for the bear case. Then estimate their profit margin. But you don't have to just throw a blind guess out there because we have their profit margins right in front of you. It says net income. Not only does it show it for the past year, it shows it for the past 10 years. So look at the historical data. Maybe take the average, or maybe factor in some things that are happening with the company. Like Hunter suggested that, Intel is building a giant $40 billion plant. That will impact certain profit margins and cash flow margins and things like that. From that point, look at a reasonable price to earnings ratio. We could see that historically just on TradingView, or just looking at, industry averages and things like that. Free cash flow margin and price to free cash flow. Essentially do the same thing you did for the profit margin percentage and price to earnings ratio. You also have that data widely available. And then you press calculate, and it shows you the prices you should be paying. Hunter, can we demonstrate something really quickly? Can you please put the annual return percentage to 0 for all three scenarios?
Yeah.
Perfect. So once he does that, we can see that these gives you the price targets of Intel 10 years from now. Let's say we look at the bear case. The bear case is predicting that Intel will be at $75.87 10 years from now. You might look at Intel right now and be like, dang, Intel's at $44.50, and you're telling me in the worst case scenario it's going to be at $75.87 if these assumptions are correct? But here's the thing. If you want a 13% return every single year, or a 10% return every single year for the next 10 years, Intel might not be worth the buy for you. Look what Hunter just did. He put a 10.5% annual return target, and that means that the most Hunter can pay is $36.42 for Intel shares today in order to get his desired rate of return. So once you have a price target, you still have to figure out, is it worth buying today? And that's why you have to have an annual return percentage, because if you're fine with 1% returns, sure, no problem. But if you have a target that you're trying to reach, it's important that you factor that in.
Yeah, you don't, at that point, just buy the S&P 500. It's safer and you're going to get a better return. It's just, anything could happen to an individual company. They have all sorts of, look at the past few months, all these companies coming out with cut guidance, anything, and they just crater.
Exactly.
So if you're not going to get, in my opinion, the required rate of return should be higher than what the S&P 500 average return is, because you're taking on more risk from an individual stock. You need to have a higher rate of return.
Okay, cool.
It's like a buffer. It's like a margin of safety. So.
Yeah, exactly. So Hunter, let's try something out. So let's say we were looking at Intel still, but let's go to the dashboard, the main page, really quickly. In 2021, Intel had an annual revenue of around $79 billion, right? It's a respectable amount of money. When it comes to valuing companies, it is so important to be realistic in and like if you're uncertain, you have to be conservative. Like for example, 5% revenue growth or 10% revenue growth annually might seem, conservative and realistic, but in reality it's not, and we'll show you why right now. Intel. So for the past 10 years, Intel's revenue went from like 53 billion up to 79 billion. It's respectable growth. Hunter, if we went back to the calculator, and let's say you put in like 10% revenue growth for one of the selections, 10% revenue growth. Let's see. That would take their revenue at the end of 10 years to $202 billion from $79 billion. It's just probably not going to happen, So it's be conservative most of the time when inputting these things. Just have the margin of safety.
Yeah, and it'll show you the revenue. This will be the 10th. So if you do 10 years of analysis, it'll show the 10th year revenue for the bear base and bull case assumptions, so you can see how either stupid or intelligent your assumptions are. Like if you're gonna 7% a year compounded doubles in 10 years, and 10% doubles in like 7.5. So it might seem like 10%. Oh, 10% is doable. That is a lot of revenue growth. Like that's doubling the company's revenue in 7 years, and they only increased it by like 26 billion in the past 10 years. And they're going to increase it by 150 billion.
Yeah.
100. I don't even remember what the last number was. What was it? 200 something billion?
Yeah, 202 billion, I believe.
Oh, 202 billion. Oh, okay. Yeah, so it's not going to happen. It's just not going to happen.
Yep. Cool. All right, so that's value stocks. Now we have growth stocks. So I just want to, demonstrate why you have to take a different approach with growth stocks. A lot of them are not profitable, so you can't really like assign like a reasonable PE and price of free cash flow and stuff like that. It becomes more of a guessing game when you try and analyze growth stocks in a value stock calculator. So that's why you have to use the growth calculator. The growth calculator simplifies things a lot. Instead of having to guess, estimate, PE and all that stuff and cash flow, it just takes the revenue growth percentage and their price to sales ratio that you intend. So, Hunter, tell us how to do this.
So, we have Redfin pulled up, and you would need to forecast the revenue growth. It's same thing, bear base and bull case, but the only difference is there's just revenue growth and the price to sales ratio, because price to sales ratio is just based on the revenue. And then once you have that, it'll give you the terminal revenue, the terminal price to sales, and then you discount it back at the rate of return. And that's how you get these prices down here. And that's what you would have to pay under to get those returns. So it is a lot harder to predict or forecast growth companies' revenue growth over longer periods of time, because they have such high growth at the beginning, and you don't know, like there's a huge jump. Like if you look up Redfin's forecast, it'll be like, I don't know, 40% revenue growth for this year is estimated or something, and the next year it's like 18% or something, and then so it's better in my opinion to go shorter. So I did 5 years. Sometimes I even do 3 years on growth companies, and then I'll give them like average revenue growth rates over those years, and then I assign a price to sales ratio based on the industry they're in, not based on their past. Because if you look at the past price to sales ratios of most growth companies in the past few years, they're absurd. It's absurd how, like, Zoom was at 113. I've seen some over like 500. It's just ridiculous. And if you put in something like a 5, that brings to 111. You think you can buy Redfin under $111 and get a 15% return for the next 5 years? No. So 0.5. And 1, I was just being generous to show. I was just being generous for 1. So anyways, this will take the base case revenue to 4.7 billion in 5 years, and right now they have under 2 billion. So it's not a ridiculous assumption on revenue growth. The price to sales is low. It's like a car. It's like an auto manufacturer price to sales, and they have pretty low gross margins. So then you just discount it back I put 15%. I don't want to go lower than 15% on growth companies, especially in this environment, because of how much riskier they are and how much more unknowns there are than in a more well-established company. Sometimes I'll even go higher at like 17.5% depending on the company. If it's a growth stock that has tons of debt, I probably won't even buy it, but I just like to look at what I think it's worth. But you need to have a higher required rate of return, because if you put in 10 or something, number one, that's a little bit below what the market average is. I'm pretty sure it's 10.5% right now, since 1921 or whatever. And there's so much more risk with a company like this that you're probably not going to outperform the market. And it's a less accurate, in my opinion, way to value a company, because there's no free cash flow. And if you were to do a discounted cash flow model or any of that, you just wouldn't basically be able to do it. They have no free cash flow.
Mm-hmm. Right. So, yeah. So the main thing is, especially in this calculator, you have to make sure your numbers are realistic. Like, especially that revenue growth and that PS ratio. Revenue growth, we show you those terminal revenue values. So, Hunter, can you, with your cursor, just, kind of like highlight where they are? These show you what the final revenue will be like on the last year of the years of analysis you have. So, that kind of helps you judge if your estimates are realistic. So, be very, very smart in how you anticipate the revenue growing. In most scenarios, be more conservative than you otherwise would be, just to give yourself that margin of safety. Price to sales ratio, in order to be realistic with that, there's a couple things you can do. One of them is looking at other companies in the industry, but you have to be a little bit careful doing that, because when the market gets overvalued and when bubbles happen, basically all companies have extremely high price to sales ratios. So you also want to factor in a company's gross and net margins to see what's a realistic price to sales ratio to give the company. For example, Hunter, can we go to like Ford just to see something really quickly? So we can see Ford, they have a gross margin of, what is that, Hunter? Gross margin of what?
16%. Basically, this net income ratio is skewed. So you go past, on their past ones, it's just skewed from the recent year. So
okay. Cool. So gross margin 16%, net margins maybe like 2, 3, maybe 4%, if that.
Yeah, around like under 5 usually.
Okay, under 5, right? So basically, when you have net margins under 5%, you're going to have a low price to sales ratio, because people aren't going to just pay it. You know what I mean? Like, because you have such low margins, it takes a lot more sales to increase that bottom line profit at the end of the year. So that's why you pay a lower price of sales.
Walmart is a more consistent one. It has 25% gross margins. And
cool. Perfect.
Way lower net profit, and its price to sales is 0.6. So
perfect.
And then you get something like Microsoft, which is overvalued, keep in mind. But still, it has 36% gross margins, and now their price to sales is 10.
Right.
Which is too high. 10 is too high for that. But SaaS companies which have like the highest gross and net margins, basically the highest earning potential based like per revenue dollar brought in, trade between like 6 and 8 usually price to sales. Okay. So
yeah. So
they have like 80%, 90% gross margins.
Yep. Perfect. So, we can see Redfin right now has gross margins of 21% and net margins of around like -5 to -8% or so. So that's why we have to be, that's why we have to give it a low price to sales ratio. So once you have realistic numbers, you throw it in the calculator, press calculate, and once you have your desired annual return percentage put in, it shows you the price you should be paying for that stock today. So that's how you do it. It's not overly complicated, but I warn you guys not to get too comfortable just like throwing like extremely ambitious numbers in there. Like you don't want to be throwing like 50% revenue growth targets into this calculator, because it's going to seem like you should be buying everything then. Being realistic is extremely important.
Especially with the multiples too. Like if I was to change revenue growth to 30%, that in the base case it would bring it to 19. But if I put this back to 16%, so from basically 11 to 19. But if I was to change this to 2, that's a 44. So it's, you got to be like, people see these inflated multiples on these companies now, and then they think that they can just assign that to every company. That's not how it works. Higher multiples are given to companies with way higher growth potential.
Yeah.
And but when you're factoring growth right now, they have higher multiples because they have higher growth potential. In 5 or 10 years, that growth potential is going to be way lower, and the multiples are going to be lower. So people who say in 10 years Tesla gets 100 PE, 80 PE, that is so dumb. That's so stupid. Like, you have to be smart. Like, I saw, what did Kathy Wood say about Tesla? She said was her price target for 2032 was like 22,500 post split. I'm pretty sure. That
post-split.
is so post-split. So now that's so unbelievably stupid. That's so stupid.
Okay. And then one other thing. So whether you're looking at the value calculator or the growth calculator, if you put your annual return percentages to 0, that will give you price targets for the stock. So we can see right now, the numbers are really low. When you set them all to 0, that gives you the price targets for the stock 5 years down the line. So if you're ever looking for price targets, feel free to just set those annual revenue or annual return percentages to 0. Just get an idea. And Hunter, I know you kind of already did this, but I just want to showcase it in a different way. Look at the base target. It's at $22.36 for the stock price target. Change the price to sales ratio to 2. So it's at 0.5. If you change it to 2, oh my gosh, the base target goes from like 22 up to almost $90. That's why realistic numbers are important when putting in assumptions. So Hunter, do you have any final thoughts for people who are looking to find the value of different stocks like we showed today?
Yeah, it's all going to depend on the assumptions you put in. Like if Mike and I were to do Redfin separately, we would have different numbers down here. That's the whole point of investing, is you are going to have different assumptions than almost everybody else. The important thing is that they're not absurd. Some people make extremely stupid assumptions, publish them under the name of ARK Invest, and put to millions of people, and it just gives these like unrealistic expectations of what to expect. And so it's very important to have something showing you how like realistic your assumptions are for revenue, which is the easiest to tell if it's possible to hit. Like, if, $1 trillion in revenue in 5 years, probably not.
Right. Gotcha. All right, well, thank you guys so much for watching today's video. If you want to analyze companies like we did today, check out that first link in the description and the comments down below. You can see everything you could possibly need when it comes to analyzing stocks. You could use our software to calculate your own price targets. Best of all, if you don't like it, you can cancel. No questions asked. It is truly an amazing tool. Hunter and I both made it. We use it every day. It is an awesome, awesome tool. And if you use the data that you have available to you, I promise you it will turn your trading game around for the better. So fundamental analysis is so important, even though it's a little bit boring. Don't make the mistakes that caused a lot of people to lose a lot of money over the past 2 years just by buying stocks at crazy valuations. Everyone makes mistakes, including Hunter and I. Every investor does. But the big thing is learning from those mistakes, and looking at a company's fundamentals are such an important thing to learn. So check it out. We have a sale running if you want to try it out. Even if you want to try it out for a month and cancel, I promise you it's worth it. So check it out. Link down below. Besides that, have a great weekend, and thank you guys so much for watching.